Good afternoon, everybody, and welcome to session one of the Successful Investing 3 conference. This is the third in our series of COVID cancellation conferences. It's sponsored by the Mid-Michigan chapter of Better Investing and by Manifest Investing. And your instructors for this afternoon are myself. My name is Ken Kavula, and I'm the president of the Mid-Michigan chapter. And I'm joined by my good friend and buddy, Mark Robertson, who's the chief director, the chief operating officer, the chief everything at Manifest Investing. Good afternoon, Mark.
Good afternoon, Ken, and good afternoon, everybody. Looking forward to a couple days of sharing of ideas. I do think it's a wonderful evolution that we've seen over the last several years when we went from an educational association where we talked in terms of company A and company B and fictitious numbers to where we are actually demonstrating in real time opportunity and community-based analysis of those opportunities. So thanks for helping to put this together, Ken.
You're welcome, Mark. We do have 2 classes tomorrow and 2 classes on Friday. If you need more information on that, check the Mid-Michigan webpage on Better Investing or check the homepage on Manifest Investing. Let's get some legal stuff out of the way real quickly, Mark, by going to our disclaimer. Everything we do in all of these sessions are for educational demonstration purposes. We're never recommending that you buy or that you hold or that you sell a particular stock. We are recommending that you do a lot of homework before you do any of those 3 activities that I just mentioned. The views that are expressed by Mark and myself are our own views, and they don't reflect any particular organization or any particular person's thinking except our own. We are recording the session and we'll put it on our YouTube channel for you to access after the class is over. And if we do own any of the real-time securities that we're talking about, we'll try to remember to remind you that we have actual positions in some of those stocks. If you'd like to be on our reminder list for the Mid-Michigan programs, please send an email to nkavula1@comcast.net. That's my wife's email, and she will find a way then to get you onto our reminder list. Mid-Michigan not only runs these conferences on so far it's been every 6-month basis, but we also run a monthly program called the Roundtable, where we share some favorite stock picks. We have a general discussion, and it's a pretty decent program that we've been putting together now for almost 12 years. Again, if you want copies of the slides that we're using in this particular class, send a note to Mark R at manifestinvesting.com, and he'll be glad to get you a copy of the slides just exactly as they were presented today. So let's start with our first slide and see where we're headed, Mark. Our topics yet to come are from theme to target, where we're going to help identify actionable trends and ideas in the stock market. We're going to talk also tomorrow about portfolio management, give you some guidelines, some examples, some resources, some ways to put together a portfolio, and then to manage what it is that you actually own. Cy Lynch is going to be talking on Friday morning about stacking the deck in your favor. He's going to try to share some of his many years of experience in putting together stock selection guides with our audience and help you to do better stock selection guides and maybe make them focus a little bit more on the important things that are on the guide. And then the panel, which is always the most popular event of these conferences, our panel has 8 stock pickers from around the country, and we'll be doing a classic Let's Talk stock. We'll each have a primary choice and a secondary choice in a lightning round. So that means we'll leave you with 16 different ideas before the panel is over on Friday. Here's our panel selections from May of 2020, just about a year ago when we ran our first COVID cancellation conference. You can see that the total return for the stocks that we chose was almost 87%. I'm directing you down to the very bottom of the total return column. There's the average. And the benchmark, that means the market as a whole in that same time period, returned a little bit more than 55%. That means the relative return, the amount that we beat the market, was at almost 32% for that 1 year period. Notice that we were really lucky. We have every single stock with a positive total return, and even the worst choice on the list had a 22% total return. So we're quite pleased with the picks we're making. Mr. Home Run, Pat Donnelly from Pittsburgh, holds the #1 spot, and Pat's going to be back making some picks again this coming Friday. So you might want to come just to hear what Pat has to say, because if we go to the next screen.
I have trouble advancing the slide because I'm in a much better position on this screen than the November selections. So, okay, I'll do it just because you make me.
And here's our November selections about 6 months ago. Notice Pat's at the top of this list as well. A real nice total return. This one is not quite beating the market. We're down to the market by about 3 points. But we did have a really unintended consequence coming out of Emergent Biosolutions. That's the company that got into all kinds of trouble with Johnson & Johnson in the manufacture of the vaccine for COVID at one of the facilities. So it just took a mighty swoon all in the space of a couple of days. We do have some really great choices on the list, however, and we're hoping by the time this list is a year old or so that we will be seeing a positive return on this particular stock, this particular list as well. We're still looking at 16.8% total return, and that's including some really nice stocks in the green up near the top of the list right there.
Absolutely. And it is early, and we're only 6 months into that one, and we continue to have fingers crossed. Sometimes things take time. All right. Well, let's go ahead and get underway with our small company. I like to think of it as discovery, Ken. I know you do too.
Absolutely, Mark. I'll let you take the lead.
All right, this is our first session of 5, so let's go ahead and get underway. This is our basic agenda for today. We typically lay out some theory and then do some, tactical homework type stuff. Audiences in the past have found a wealth of opportunities for further study, but we really are going to be focusing on just these 3 elements. We think that having smaller companies in your portfolio to provide balance and appropriate diversification in your portfolio is extremely important. I would call it a priority, might even call it something higher than that. It's if you want to have a decent performance, your probability of success is actually increased by discovering these type of companies. One of the things that we will be emphasizing is that we believe is you can find these faster growing companies that are they're often younger in their life cycle, sometimes with a little bit of a limited history, sometimes they're a little bit more early stage, but you do not have to compromise and sacrifice quality. You still want excellently managed companies, and we think that focusing in on all of those typical attributes, the same thing that come to play with all of the up, straight, and parallel stuff that we talk about, is equally important, if not more so, when it comes to the smaller companies. We'll share some of our favorite sources, and of course, along the way, we will engage or indulge in some case study activity. Anything to add to that, Ken?
Well, I think it's important, Mark, to understand that from the very beginning of better investing, there's been a couple of different ideas floating around as to what makes a small company. It's in our opinion, at least, the two definitions that have come down to us in the last 60 or 70 years. One of them has to do with how fast sales grow, and the other has to do with how many or how much dollar amount in sales actually exists on a particular fiscal year. We happen to think that the sales growth forecast, which is in percentage terms, is a more accurate way to measure whether a company is small, medium, or large. And in fact, we note that in the original writings, it never was referred to as a small company or a medium company or a large company. Rather, the terms that were used were faster growing companies and slower growing companies, which leaves that middle group of just normally growing companies. The words small, medium, and large were kind of attached as the years went by, but we're quite happy with measuring large companies as growing at 7% or less, and measuring medium companies as growing somewhere between 7 and 12%, and measuring small companies as growing greater than 12%. Remember, we're talking about sales growth, not any other kind of growth. Everything, in our opinion, and in the opinion of the founders of our organization, everything comes from sales. If you don't have sales, you don't have earnings. And if you don't have earnings growth, then you don't have stock price appreciation. We think that this percentage growth in sales is a superior measure of company size, and that's what we're going to be using throughout our discussion today. Our organization has traditionally suggested that you have about 25% of your holdings in slower growing, larger companies, that you have about 25% of your portfolio in faster growing, smaller companies, and that the workhorses of your portfolio, about 50% of the portfolio, be devoted to companies that are growing somewhere in that 7 to 12% range. And you'll find a large percentage of companies that actually qualify in this medium-sized area. Some of the very best companies that we can take a look at are in this medium-sized area of sales growth between 7 and 12%.
Yeah, I think we should dedicate a session just to those. I put one together a few years ago that was very well received out in Puget Sound. Maybe we should have a workhorse session here pretty soon too, Ken.
That sounds like a really good idea. All
right, just to reinforce, I mean, going back to those original teachings and the original lessons learned by the modern investment club movement, again, just to clarify, we talk a lot about the 15% target over the long term. Again, that applies to the rate of return. The long-term rate of return in investing is somewhere in that 8 to 10% range. So we're talking about attempting to outperform that by a few percentage points. And again, the different pieces in the puzzle, the small, medium, and large, or as we should say, the faster growing, the slower growing, and the workhorses, basically add up to the total portfolio. We do believe that you want to have that blend and have an overall average sales growth forecast of 10 to 12%. In fact, as Ken and I will probably make the case, you can strike the word probably, we'll make the case that you should probably be towards the 12% end of that perspective, unless you're talking about a personal portfolio with special considerations like somebody with a whole lot of experience and a whole lot of capital preservation. Maybe you dial that down. So again, just to reinforce what Ken was saying, choose 25% from the blue chips, slower growing companies, 25% from the promising emerging smaller companies, and the rest from the Gen Texas and those type of companies that just have wonderful, excellent management, and you'll in pretty good shape. So go for that distribution. All right. One thing we thought we would share with the audience here today is this notion of all of the above investing. We talk about it a lot. You want to have that blend. And what's kind of interesting about this chart is that it falls on the heels of the lost decade where the S&P 500 went basically nowhere from 2000 to 2010. So we're looking at performance since basically that time frame, since June 2011, roughly the last 10 years. I want everybody to note that the blue chips, the S&P 500, generally the larger companies with the lower growth rates, actually performed quite well over the last 10 years. Here's those workhorses in the middle, basically doing their job, holding things down. And it's actually kind of flipped right now because over most 10-year periods, this red bar would be the biggest bar. This is your faster growing in general, faster growing smaller companies. And they have taken a few years off, even with how much they've recovered here over the last year. And again, the value line arithmetic average, again, the equally weighted 1,700 companies in the value line standard edition basically does represent all of the above investing, and it represents a blend of all three of those different categories. Anything you want to add to that, Ken?
Well, what's important to understand is that these are all indexes. All four of the bars represent large groups of stocks, and we would never hope that you'd be investing in 600 small companies to come up with your small portion of the portfolio. We'd hope you'd be able to pick 3 or 4 of them out of this index, or something that's not even in the index that completely outperforms the total index value. That's the beauty of stock picking, that you can take an index and you can choose to buy just the ones that have a chance of being better performers than the index itself. And in fact, that's the major goal when you set up an investment club or when you set up a personal portfolio. Your goal should be to beat the indexes, to do better than what the indexes are doing. When we get to portfolio management in our classes tomorrow, we'll be showing some real examples of how that can be done, and done quite handily by just a group of amateur folks sitting around once a month and deciding what they're going to buy, sell, and hold.
All right, and just to kind of put things in context here a little bit, here's a look at the return forecasts in the Value Line Standard Edition. What I did is I divided up Value Line into, I'm not using the S&P classifications now, I'm basically taking and sorting them by their growth rates. So the 25% with the lowest growth rates, again, there's some awesome companies in there. They've been on a roll for 10 years. Their return forecasts are actually quite subdued. They've been really on a run here over the last 10 years. The medium one check, the workhorses check in right in the middle again as usual. But now what we do see is, even though the overall average is relatively low at 6 to 7% for the average return forecast, we are seeing more opportunity amongst the rabbits. And again, this would be the 25% of the Value Line Standard Edition with the highest sales growth or growth rate forecasts. So right now, the opportunities, and this has been true for the last year, maybe 2 years, we've been encouraging. We think it's always a great idea to shop for these type of companies. We think a little additional emphasis right now might not be such a bad idea. So we're always on the hunt for them. We just hunt for them a little bit harder when under these conditions. Anything you'd like to add to that, Ken?
No, I think you did a nice job.
Cool. All right, so let's talk a little bit about, we've been doing this now for many years. Actually goes back to the late 1990s when we would take the Forbes list, which came out of the best small companies, came out around Halloween every year. And we would, as a community, try to extract the best opportunities we could spot. And Forbes actually stopped publishing that list a few years ago. And Ken and I both basically took on the task of, maybe we can actually improve the process. We'll talk about that in a little bit of detail later. But one of the messages we want you to take away is, again, we're talking about double-digit growth rate companies, so smaller companies, faster growing companies. But look at those three up at the very top. I don't even know what the companies are, but it's three relatively small but faster growing companies that have those excellent characteristics of up, straight, and parallel. So you do not have to settle for roller coasters and very unusual looking business models as you study your companies. You can find companies like this, and basically that's what we have set out and what we continue to do on a continuing basis. So again, we think when we're looking for the best small companies out there, we define best, as it says down here, as an excellent quality company. How do you become an excellent quality company? Well, at Manifest, we basically say you got to have good financial strength, good stability of earnings, good predictability of earnings, and your growth and your profitability should compare favorably versus your peers and competitors. So we look for those type of companies that have a good looking Section 1 or Section 2 during a stock study, but that also have a superior return forecast. You can have an excellent company that's just not on sale. So that, again, you just stick that back on the watch list. And but as far as buying and owning and practicing good stewardship, you want both of those two characteristics.
It's important, Mark, just to point out that every one of those examples has earnings. They have a blue line. They actually make money. And that there's more than 5 or 6 data points on these graphs, which indicate the companies have been around for a longer period of time than just a few years. The reason for that history is that we'd like to see what happens when they go through a real recession. And many times you have to have a history of 9, 10, 11, or even 12 years so that it includes a recession. We, of course, have just gone through a very abrupt up and down kind of movement because of COVID, a very unique kind of recession, but it did give us a little bit of an idea about how some of the companies would handle an extreme situation. Unfortunately, with the complete shutdown mandated by the government, many of the industries couldn't tell us too much because they didn't have any business to manage. There was nothing really there for them to do except wait patiently until things opened up again. So I really want you to not settle when you're looking for a small company. Demand out of a small company the same things you demand out of a high quality, large or mid-sized company.
Very true. Very true. Okay, let's go ahead and keep rolling. So Ken, I think we'll go ahead and kick off with this one with you.
Okay, I'm going to try to get to
switching to,
and I'm going to try to get to Better Investing. I'm logging into my Better Investing account.
I'm impressed that it doesn't come up.
And what I'm looking for is the tools that will allow me to do some searching. And what I'm going to do, what is this asking me to log in? And what I'm going to do is demonstrate one of my favorite places to find small company ideas. It's been especially useful in the last year or so when I've had a paucity of ideas, when a lot of the companies just blew right through earnings estimates and everything, and finding good small companies was a little bit more of a chore than it has been. And that's this small company predefined screen on this search engine that I'm looking at right now. Now I'm going to ignore the search engine off to the side, although I do use it. I'm going to ignore the heat map off to the right side here, even though I do use the heat map at various times. And I'm going to focus right here on these predefined screens. And I like them because they involve one button. I click one button and suddenly I have some ideas. If you check down in the corner down here, today, when I did this search, I get 19 companies. 4 days ago, when I started prepping for this class, I got 14 companies. So 5 companies have entered this screen in the last 5 days or so. And it's easy to take a real quick look at these companies and take that list of 19 and bring it down even further. If you look, there's a button right here next to the first company on the list, which is Alarmcom Holdings Incorporated. And if I press that button, I get a thumbnail of earnings and of sales. Notice that sales line, strong history for a relatively long period of time of sales, and since 2016, strong growth in earnings, except for the year from 17 to 18.
Ken,
All in all, go on, Mark.
I'm just curious, do you happen to recall who might have brought Alarm.com to the attention of a national audience at a convention about 3 or 4 years ago?
Well, since you're interrupting me, I'm going to guess it was you, right?
It actually came from Brown Capital, so we'll be talking about that later.
Great, great. But what I'm showing is that you can sort this list into things that I'd like to study more and things that I'm not interested in. I use a very high-tech pad and pencil where I just write down the ticker of a company that I'm interested in. And then with this button right here, I can move to the very next one on the list. Well, that's a pretty beautiful up, straight, and parallel kind of graph, the exact kind of graph that I would be interested in if this were a large company or a medium-sized company. And of course, I'm interested in it as a small company. Inghouse Systems. Don't know very much about it, but I would put it on my list as I'm interested. I can go through all 19 stocks, and Inghouse is a Canadian company, and it exists in our database with 2 tickers. The first ticker, this one right here, EGHSF, is for the ADR, which is traded on the American stock exchanges. And the second one, ENGH.TO, is for the one that's traded on the Canadian exchanges. If you're interested in Canadian stocks, if they have a ticker where they trade in this country, that will keep you from paying trading fees to a discount broker. If you try to trade on the Toronto Exchange through most discount brokers, you will pay a fee, even though you don't normally pay fees when you buy stocks. I'm going to go through just 2 or 3 more. Here's a bank, First Foundation. And again, a very interesting picture, and it's something that I might want to take under consideration. This bank isn't nearly as pretty as the last bank, a period of kind of flatness right here in earnings, but for the last 3 or 4 years, it certainly has done nice. It might be something you're interested in, and you can keep moving on these graphs all the way to the 19th button. All I'm going to pull out and talk to you about real quickly is I'm amazed right now by the number of regional banks on this list. If you look down the industry column, you'll notice that probably 30 or 35% of the stocks on the list are regional banks. What that tells me is that there might be some real opportunity to pick up some really high quality regional banks, and they might be still sitting at a price that would be deemed a buy on your stock selection guide. I would urge you, if you haven't done very much work with banks, to learn how to study a bank. We have some great additions to the SSG Plus to help you study banks, and then look to put a regional bank into your portfolio. In the clubs that I belong to, First Financial Bank, FFIN, and Western Alliance Bank, WAL, have risen to the top of our best performing stocks in our portfolios right now, and it appears that both of them still have room to run. I would not classify either one of them as small stocks, but I would classify both of them as good, solid, medium-sized workhorse stocks, the kind that you want to put at about half of your portfolio. This tool is great. I also love the value stocks that you can pull up by just pressing a single button. Value stocks traditionally are stocks that are trading at a price lower than their intrinsic value. And while that's not always true anymore by a value stock, it's still often true enough that you might take a look at some of these stocks, again, doing the same thing that we chose to do, pressing that button. That's a pretty nice picture, and I have no idea what this stock does. Addis Home Care, well, the name gives me a little bit of a hint. Here's Alimentación Couche-Tard. I know this is a gas station retailer. A Circle K is what we know it by more often here in the United States. And this is a Canadian company. You can see that it trades under a number of different tickers, and two of them have this .to attached to them. Here's a company that you might not consider a value stock, and yet here it is coming up on a value screen. This is Amazon. So again, you can go through this screener very quickly, reduce the number of stocks to stocks that you might be interested in. And I'm just going to point out that there's also a large number of regional banks on this value list. As I scroll down, you can see the regional banks on the list. Maybe 20–25% of the list is regional banks. There's that Western Alliance Bank that I was talking about earlier. Certainly has a beautiful set of lines. You can't ask for much nicer than something like that. So here's one of the two screeners that I use on a regular basis, and it's a great tool for ideas. Nothing's going to guarantee that all those stocks are winners. Nothing's going to guarantee that they're all in the buy zone, but it's certainly a great place to go for ideas. Let's go back to the main program, and Mark, why don't you take the screen back, okay?
Okay, I'll whisk it back. Should be showing on your end now.
Yep, looks good.
All right, so do you see the fund manifest leaderboard here?
Yes, I do.
Okay. Well, the reason we wanted to bring this up is what you're looking at is we follow about 600 funds at Manifest, and the vast majority of them are equity-based funds. And you're looking at the top 27. These happen to be the 27 that have beaten the market by greater than 5%. Most of these entries are for the last 10 years, unless the fund was actually started in that time frame. So if the inception is, as you can see, the top two are 2014, 2018. They do not have a full 10-year track record, but you can compare relative return by the way that we calculate that. So that is something that can be compared side by side. So here are 27 funds. Most of them are mutual funds. Some of them are exchange traded funds. The mutual funds are designated with this M in front of the ticker, as you can see here, that basically says that's a traditional mutual fund. And so you're looking at 27 that seem to know what they're doing. in most cases for at least 10 years. And the reason that we bring this up here is this is a profile of success. And a real common denominator is the growth rate. The average sales growth rate of the holdings in these particular funds actually checks out to be 15 to 16%. And here are all the specific numbers in this growth column. So notice that virtually every one of these successful leading funds has a decent double-digit growth rate. The only two that don't actually round off to 10, and they're large index funds that are basically checking in at 10%. So you can basically say this is a list of double-digit growth collections of investments. So from top to bottom, pretty good story. Anything jump off the page that you can?
Well, just the fact that the first one on the list has been in the news an awful lot. This is one of the darlings right now, or it was one of the darlings. It's on a little bit of a rocky times for the last 3 or 4 weeks, but Kathy Woods is the manager of this particular mutual fund, and or it's an ETF, I guess.
It is, yeah.
And it really is made up of some of the most current kinds of things that you would ever want to include in a portfolio.
Right. She's very aggressive, very long-term. We're going to actually spend some time with Kathy and this particular fund tomorrow when we talk about trends. But yeah, it's loaded up with some companies like Tesla, a couple others, some that we'll be talking about here in a few minutes. And it has hit a bit of a cold spell, but full disclosure, I bought some yesterday morning. I figure it's been hammered enough and actually going to tiptoe back in. It is, among my more speculative holdings. Why is it speculative? Again, reaching for an awful lot of growth, and note the quality rating. These are not, there's probably not a lot of up straight and parallel in that portfolio. So the success
Mark, we're getting some questions, Mark, about how the quality rating is calculated for a holding that has lots of stocks in it, like a mutual fund or an ETF. Can you do about a minute on how that quality rating is calculated there?
Right. We're going to actually look at it in greater detail, but for now, all we do is we do a weighted average of the individual quality rankings in the portfolio. And we'll actually show that in a slide, which will help with that. But you are looking at the weighted average quality rating for the holdings. So if I'm looking at a list like this for ideas, I'm going to be naturally drawn to some of these higher numbers like the 90s and 80s as I'm thinking about mining for opportunities and looking for stocks to go after. I'm just going to be naturally drawn to what I'm going to recognize as more predictable, better financial strength, all that kind of stuff. That doesn't mean that there aren't opportunities in the others. In fact, we're going to talk about Motley Fool small cap in a few minutes. That's a small company, exchange traded fund. But I think it will come clearer, Ken, as we actually take a look at some of that. Again,
Great.
The price of not pursuing growth in your portfolio is basically right here. If you look at the average relative return, and keep in mind that these are mostly the best mutual funds, if you take the average of the 600, it's actually a negative relative return. So without growth, you basically sacrifice return. And that's our message with that particular slide. Well, here's a look. Ken, nice segue. This is actually a look at the companies that are in Ark Innovation. This is the hottest. It's the one being talked about the most. And we are going to talk about some of Kathy Wood's stuff tomorrow also. But notice that the companies in it are pretty frisky. Notice that they also first bought Tesla 7 years ago. And they are pretty staunch about it. And we did a number of sessions on how that could make sense as a speculation back about a year ago. Maybe we'll dust some of that stuff off and see how that's aging with time. But as you go down that list, you see some fairly, I think I called them frisky, frothy, well, however you want to think of it, companies from top to bottom. This is all the holdings of the exchange traded fund. And the ones that I have circled for you are ones that have been first bought. Again, that's the key phrase here. First bought within the last 3 months or so, 6 months or so, maybe sneaking into 2020 a little bit. Here's Exact Sciences. We're going to spend some time with that one. Also, she bought that one a little bit ago. But as I go down a list like this, I want to know, what are they currently more interested in? They've recently added to Regeneron. That's been selected by the roundtable a couple of times here fairly recently. So again, from top to bottom, I'm going to go down this list and see if I can extract any notion of value or interest as a potential investment or speculation in some cases for a fund like this. So again, this actual listing comes from going to Morningstar and drilling down into the portfolio, looking at the specific portfolio and asking and answering the question, what have they been buying or interested in lately? Okay, how do they stack up in our universe, our approach to looking at the world? Here are those companies that I circled on the previous slide. She's taken a fairly strong interest in gaming and esports, with companies like DraftKings and Skills being added, and there's a couple on there that I'm probably forgetting, but you can see that there are some fairly interesting companies here that might merit a little bit closer look. As Ken was saying, they have been getting hammered quite a bit, so they have some companies that are probably oversold. We consider a relative strength index, that's what the RSI stands for, less than 30 to be a potentially oversold stock, worthy of picking up. And I want you to notice all the 20s and 30s that you're seeing in that column. So many of the holdings in the Ark fund have been getting hammered here lately. So they've been driven down. Driven down means that some of these Morningstar price to fair values have actually been going down with them. Some of these companies are potentially on sale as a result. So again, if I'm looking for ideas for companies to study, looking over the shoulders of somebody who knows what they're doing, like Kathy Wood, this is the process that I'm going to be taking, and just looking for something that really grabs my attention. Any thoughts, Ken?
Well, there's all kinds of column headings right here, and we're not going to take the time to explain each one of them, but this is the kind of discussion that we have at the bull sessions that we run every Tuesday at 2 o'clock. If you're interested in this type of discussion about stocks that are of interest to us, try attending a bull session, 2 o'clock in the afternoon every single Tuesday. And again, all those bull sessions and all of these particular sessions are going to be posted on the Manifest Investing YouTube channel. We've been posting things there for over 10 years now, and just like all of the past conference classes are posted, these will be in the same place.
Okay, so a lot of times I'll get the question, well, which one would you attack, or how would you identify which one to start studying on a list like this? And the quickest answer I can give you is I would be watching for stellar or double-digit projected annual returns. That's no different than Section 5 of your stock selection guide. So I'd be looking for something in the teens, decent quality. I would love to see a relative strength index down around 20, perhaps under 30. So you can see there's a number of opportunities there. I like upside as much as all of you, so I would be steered by that. But I would probably pay the most attention on this particular list to the ones that have the larger projected return on value. And that's a calculation or a characteristic that we've been exploring. Again, not going to go into any great detail other than to tell you it's the projected pre-tax income divided by the enterprise value of the company. The enterprise value of the company is basically the market price plus the total liabilities and correcting for the cash. So again, we have sessions that are dedicated to that calculation, and we will be spending a little bit more time with it. So with that, Ken, we can go ahead and switch back to you. You want to show your other favorite approach here?
Well, I'm always searching for small stock ideas, and the other place that I look on a regular basis is to go to manifest investing, and I'm going to switch from the SSG Plus to manifest investing. I'm going to do a stock search, and I'm going to do a new stock search, and I'm left with a very, very simple screener, but it's very elegant. It's very easy to use, and it gives me enough meat that I can keep myself busy for a long period of time. I'm going to focus on only one piece of this screener. You can see that there's a number of different categories that I can place in my sieve, in my screen, if you will, to narrow the database. But I'm going to look at the manifest rank. We like to call this the ivory soap screen, and I'm going to put in here 99.44. And for those folks that are as old as I am, or nearly as old as I am, you're probably recalling the old ivory soap commercial. It's 99 and 44% pure, and it floats. Actually, it floats because there's a lot of air in it, but they like to tell you it floats because it was 99 and 44% pure. Well, I'm asking for the top 0.5% or so between this number and 100%. I'm asking for the top of the manifest rank. Manifest rank is a combination of quality and par value, potential return value. And when you search on it, you get a very interesting list of companies. That's it. It's not a real long list. This is about 0.5% of the entire database. And within that 0.5%, I can look and sort this by growth. And you can see that except for one company at the very bottom, I'm looking at double-digit growth. I'm looking at companies that we could argumentatively classify as growing at the fastest rate or at the faster rate compared with the workhorse companies and compared with the larger, slower growing companies. A lot of really great ideas on here for you to take a look at. They're not all small by intuition, but they certainly are all small by growth rate. And that's a hard concept to wrap your arms around sometimes, but it's a necessary concept because the size, come on, let me just finish this one point, Mark.
Okay,
the size of the company isn't as important as the growth rate that you're going to place in your portfolio. And Google doesn't immediately strike me as a small company, but with a growth rate of over 16%, I certainly have to classify it in that faster growing category. Go on, Mark, I'm sorry.
Well, I was just going to say, as you started to do this, my thoughts went to, don't you want to limit the growth to 12% and above? And then I note that most of the list is above 12%, certainly double digits, right? So
yeah,
I'm kind of impressed by that. And here's a sneak preview. There's several Friday companies on there as we lists.
And I've found, Mark, that for the last couple of years, I very rarely have to limit this list to 12%.
Yeah.
It just automatically kind of ends up with an almost perfect list. And just by sorting it the way I did by pressing the top of the column assures me that one or two that have made the list are there for some good reason. And the good reason for Gentex is it has a quality rating of 100 and a par value of almost 14. This is a good, solid Michigan company, and we invite you all to invest money in the state of Michigan. We can use all the money that you want to send us our way. So with that said, there's some great ideas on here, and I would assume that some of you are finding companies on this list that you are unfamiliar with. And if you're unfamiliar with a company, then it certainly becomes a company that you should be doing a little bit deeper dive in. Sometimes we kind of gloss over companies because we think we know what is happening, and yet when you move into them and look at their numbers, you're pleasantly surprised. I would take a nice look at Malibu Boats and at Mercury Systems and at Google for that matter. iRobot, Green Brick Partners, Houlihan Lokey. Take a look at these companies because I think you'll be pleasantly surprised at what the SSG is telling you. I love to use manifest investing in tight coordination with my own analysis on an SSG. The two tools just complement each other something wonderfully, and they provide verification and validation about what I'm doing. But here's another way that I come up with ideas for faster growing companies. Let's go back to the main theme, Mark.
Okay. All right, do we have the confused Rhino up and running here?
I'm not seeing it yet.
I might have to toggle around, right?
I see it now, Mark.
All right, there's our confused Rhino. Point that we like to make in this presentation, and sometimes we don't make it big enough, so I decided to make it bigger letters. Small company or small cap is not necessarily small company. You can be a small cap and simply be damaged goods or something that you might find interesting at a garage sale. But small company is, again, early stage, faster growing. And the reason that the confused rhinos are on this picture is it's one of the things that Wall Street basically always gets wrong. It's a wrong perspective to jumble all that stuff together and call it small cap based on the opinions and, in some case, emotions surrounding these companies. Many years ago, you guys will remember that Ford went from being a mega cap to a micro cap in a matter of a few days. It's always been a big company, but its capitalization actually changed dramatically in a matter of a few days. So the capitalization, again, is more like a voting machine, can be emotionally driven, but the top line sales growth, the sales characteristic of a company is really what determines what type of company it is. So we like to make that point. So that's a mistake that the rhinos continuously make. Well, here's a guy that doesn't make that mistake. He calls the fund small cap, but it truly is a collection of faster growing companies. This is the Motley Fool Asset Management, Motley Fool Small Cap Growth, run by Bill Mann. And the reason that I know that the companies are relatively small is because the weighted average cranks out at 18%. So this is kind of the answer that you were looking for a few minutes ago, Ken. How do you characterize the quality of an exchange-traded fund? Well, just look at this column right here. What you're looking at is the quality ranking for all of these companies, and some of those ticker symbols may be unfamiliar to you, but at the weighted average, and here's the actual weights, 5%, 5.5% of the fund is in this HSKA. The weighted average of those actually comes out to be 58.8. So HSKA has more influence on the fund quality or any characteristic than STAG. So again, in the process of going after, looking for ideas to study in greater detail, just simply going down that list from top to bottom or peeling away. Again, I like these projected return on value numbers. I might take a look and see if I know these companies that have double-digit projected return on value and see if there's a little bit more that I could go for. Same thing is true. Any high-quality rating in combination with a high Section 5 projected annual return is a company that I'm going to perhaps run up the flagpole in the spirit of true screening and see if it's something that I want to dig into a little bit deeper. Anything else on that page jump off and get you? Do you think that takes care of the quality score for a fund?
Well, I have a couple people in the back concerned that this is only 84.82% of the assets. Folks, once you get past 2/3 or 3/4 of the assets, the numbers at the bottom of these columns change very little. So we have discovered that including the top 25 holdings in any of these mutual funds or any of these ETFs gives us very reliable data and gives us very reliable numbers for growth, for quality, for almost any of the values that we're coming up with weighted averages on. You don't have to go to 100% to come up with very accurate data at the bottom of these columns.
Yeah, and I would make the statistical distinction, and I'll just do it for a second, Ken, don't get worried. There's a difference between modeling the fund and building a representative sample. And what Ken is telling you, that 84% is actually quite large. The 25 top holdings in this fund account for 85% of the value of the fund. It's fully characterized. It's fully representative with that for sure. I guarantee you that you put the next 15% in, the numbers on that bottom line are not going to change. Not dramatically, not materially.
We'd have to get you all into a statistics class, and my granddaughters that are both taking statistics right now at university are telling me that's one booger of a class. So rather than take that class, just take Mark's word for it. This is pretty good arithmetic.
Yeah, I was pretty good at arithmetic in my day. All right. Let's talk about another fund. Again, we're talking about sources of ideas. This is the Brown Capital. And the reason I love to bring these guys up, because they actually have the words small company in the title of their mutual fund. I think they are still the only ones. So they might be the only rhinos that get it. The ticker symbol is BCSIX. It's Brown Small Company. It is closed to new investors. What you are looking at here is their entire mutual fund. And you can see that they actually have a whole lot of conviction and discipline. There are companies in this fund that have been in it since 1993. You can see that, the first bought dates on these date back decades. So they think like we do. They eat breakfast like we do. They go hunting for stocks like we do. So anytime that they discover one, and it jumps up on the screen like this one right here, Repligen. I don't know who Repligen is or whatever, but they first bought some within the last quarter. And they not only bought some, they dedicated 1%, which for a mutual fund is actually a fairly large stake to get started with. And so Repligen is a company that, again, this is just going to jump off the page at me and say, Mark, Brown Capital likes it. Maybe you want to take a closer look. There's a number of other companies on here that you guys will all recognize. Ken, check this one out. Neogen being on here. You can just see these are the type of companies. Here's Proto Labs. Here's IRTC, which has been very interesting. Here's the one Ken was talking about a few minutes ago, Alarm.com.
Right over Viva Systems also, Mark, another real popular one in our community. Yeah.
Viva Systems, Tyler just bought one of our other favorite companies, which happens to be on here, I think. Yep, I think Tyler bought these guys. Or somebody like that. And anyhow, from top to bottom, some interesting companies to study and at least see if there might be some opportunity offered that you want to follow. Here's a quick look at the business model analysis for Repligen. I see why they like it. I see why I at least want to have it on my radar screen. It's almost up straight and parallel. Pretty decent looking stock price track record there. Pretty decent looking sales growth forecast. That trend line is in the mid-20s, so fairly steep. Pretty decent looking track record. The profitability suffered here. I'd probably scratch my head and wonder, what in the world happened there. Maybe there's some explanation. Maybe it was related to the recession or COVID. Would like to understand that, but I see profitability stabilizing in the low 20s. So I'm happy with using a 22% projected net margin. Shares have been fairly steady for the company. It's got an elevated PE ratio, very much like an early stage Paychex or Neogen. So yeah, this can happen for a while during the life stage of a company. I basically audit that by taking a look at the projected return on value that we've talked about here quite a bit. That's a fairly normal or average value for projected return on value. So any type of a number between 5 to 10% for par would be okay by me for the calculation. So that 50 checks out okay for now. These guys, when they go to the bank to borrow money, are getting it at a pretty good rate, 5%. And again, here's that relative strength index, which could be somewhat influential in why Brown Capital was interested in it. That's potentially oversold. Could be something on sale. And the company has been a little bit discovered. You can see the inflated PE ratios. And again, it's worth taking a closer look and either becoming an owner or putting it on your pounce list. Anything else on the page that jumps out, Ken?
No, I think you did a real good job of covering that particular one. It's a brand new company to me. I had never even heard the name before. So,
well, I'll tell you what motivates me here a little bit is it reminds me of Neogen. It reminds me of Mesa Labs and companies like that. They make that equipment, that stuff that is in the labs for companies that do drug development and contract manufacturing. So you can see up at the top what they do. I suspect that Hugh McManus is familiar with the company. But one of the other things that just going through a process of drilling deeper into a company like this is right here. Here's some other companies. I don't think I know any of them. So they might be worth seeing how they compare. Maybe there's some opportunity there also. I don't think I've studied one of those.
And it's a great point, Mark, that once you find an interesting idea, you can kind of search for peers and competitors, and you might find an equally interesting idea in that particular list. So where did this come from? Right from their own materials, Mark?
The comparables come from our database via Y-charts.
Okay.
That's where this is coming from. This is obviously from an investor relations presentation.
Okay.
Yeah, I understand what they do now. I mean, I love Mesa Labs. The other one that really knocks me out when I think back and reminisce is BioReference Labs. How wonderful that was to our community, discovering it in a method very much like this, and then riding through the storm versus the short sellers. All right. One last area that I really like to turn to for idea generation in the spirit of screening is I do like to follow Chris Jenner, who is a principal at Rock Springs Capital Management. This is from insidermonkey.com. You can sign up for it. It's free, but you just simply sign up for it. And you can actually look at the holdings based on the latest 13F filings for any hedge fund that's on the list. And there's a bunch of them there. But Chris Jenner used to run the T. Rowe Price Health Sciences Fund, has a heck of a track record for identifying opportunities, emerging opportunities in healthcare. So looking down this list, I'm always intrigued by, well, they've been buying these lately. They're brand new in the last quarter. So they're buying them now. They're interesting to them now. Some of these numbers are actually quite large in terms of the percent of the portfolio that are being dedicated. Interesting ticker symbol. Might be worth throwing that one on a SSG and seeing what it looks like. But again, this is just the process of mining for potentially very, very rewarding opportunities.
Mark, would we have to infer, Mark, that the ones without ticker symbols are privately held companies?
They're not all. I did take a quick look at this one. This one is in COVID drug development, and it should have a ticker symbol. I don't remember the ticker symbol. I'm not sure why they're not there. It is often the case that they're private, but I think most of these that are shown here actually do have ticker symbols. Actually have tickers, even though they're not shown here. You just have to do your research and dig in a little bit deeper. Like I say, this ATEA Pharmaceuticals is definitely a publicly traded ticker. Here's a look at the top 20 holdings of the fund. Again, this is Chris Jenner stuff, so it's going to be heavy. I think you can see that a pretty good portion of it's in healthcare. And it's usually in healthcare disruptive technology many of the times. So from top to bottom, some very familiar names here. I will never, ever forget spending time with Carol out in Sacramento and hearing about Intuitive Surgical. What was that, 10 or 12 years ago, Ken, when we stayed at her house?
It was a long time ago, yeah.
And Carol singing the virtues of Intuitive Surgical. I know that they had quite a few shares back at that point in time. Again, this is the type of stuff that can almost become life-changing when you find an opportunity like this. I didn't listen closely enough. I did eventually become an owner, but sometimes this stuff can be just extremely rewarding. The one that came up as I was looking down this list is, again, something that's been added to fairly significantly here recently is Exact Sciences. The reason it came to mind for me is I drove by at the building on Friday on the way to a family wedding in Madison, Wisconsin. Here's the building up here on the right. I have a niece who works there. This is the company that makes the Cologuard test kit that you can be basically screened for colon cancer, colorectal cancer. And the really neat thing about these guys is they are growing dramatically. The key word on this page is right there, early detection. We know how important early detection is to cancer. They are working on early detection methodologies with Mayo Clinic. Just really some neat stuff, and there's a lot of story here. Even if we are talking about, pardon my sophomoric moment, we're talking about mailing in poop here. It's really an interesting company. Notice that they are talking about doing cancer screening using the blood. Really kind of neat stuff, especially with some of the biotelemetry stuff that's going on also. Again, I'm also swayed by the fact that Kathy Woods is interested in this company. So is Artisan, so is T. Rowe Price over at New Horizons. This is another very successful mutual fund for small and medium-sized companies, Delaware mid-cap growth. So some smart people are following this company, are interested in it, even in an early stage. And then again, the comparables for this company, I know most of these, so does most of the audience. And this is one that has been very good to the Kavula household. So yeah, any company that's kind of batting in this part of the lineup, I'm interested in learning more about them.
Let me give you a growth driver for this company also, Mark. The group that controls the setting of standards for testing in healthcare recently changed the time when you're supposed to be starting your colorectal examinations, and they moved it from 50 down to 45. So they opened up a huge cohort of individuals that are suddenly going to be testing. So not only did we get a large number of new people added to the group that's being tested, but they'll be testing for 5 years longer now in their lifetime than they had ever been testing prior.
Well, I have to admit that I cringed a little bit when you said opened up and thought of an endoscope. And if these guys could come up with a way to avoid the endoscopic exam, I think they're probably a worthy opportunity to study in greater detail. I'll just leave it at that, Ken, because I think we're already in.
I'm going to give you the 5-minute warning too, Mark, okay?
We are done. I think this is my last slide. The reason I put this one up is, again, we are talking early stage. We're talking about an early stage investment, which some of you just lost consciousness when you saw this. There are no earnings. The earnings actually are floating down here below zero. They are beginning to sell their products, and again, the development efforts appear to be going in good directions, good pipeline, all that kind of stuff. They actually have revenues, thank goodness, because the earnings are down here. But again, when you look at the longer term picture for the company as it matures and gets to that breakthrough moment, this is a pretty powerful moment. I don't know where it's going to be, nobody does, but the profitability is measured by the percent net margin has been continuously improving. It's headed for positive levels sometime in the near future. Again, very early stage, not for everybody. You're speculating. It's a leap of faith if you want to think of it that way. But under the assumptions that are being made here, yeah, there's no PE ratios. I know some of you just lost consciousness again. For a company in this type of conditions, this type of industry, this type of field of opportunity, a PE of 40 out in that time frame, along with traditional profit margins. Again, look at the trend. Look at the trend. This is early stage. It is not for a core holding. Probably won't be a core holding for 10 or 15 years, if it's successful. But there's a reason that Kathy Wood and Delaware and T. Rowe Price, New Horizons, and Artisan are interested. That's the reason right there. The trends are powerful, and it appears to be a very well managed. And plus, Ken, you ought to see the spectacular glass and open architecture. It's really cool. I wanted to put in
Mark, and it's classic early stage investing too, Mark, because when you see a positive earnings number begin to appear in some of your data sources that are looking into the future, then I'm looking at that one dot just floating up there in 2025 right now, which I know is coming from a source similar to Value Line.
It is.
And I'm saying to myself, somewhere between 2023, where the prognostication is negative, and 2025, this company is going to become profitable. And as it becomes profitable, it becomes more and more interesting to investors throughout the whole investing community. So classic early stage kind of investing, and the kind of stock some of our clubs are eager to discover.
Yeah, and again, it might not work out, but why not a small position, again, with that part of your portfolio that we've already given you permission to be a little bit playful with. So there you go. There you have it. All right, quick reminder. Again, we just want to close with a reminder about how powerful this stuff can be. Ken and I have been doing the best small company stuff for the last several years. Here's the track record. At the risk of jinxing us, we're ahead again this year, and we're 6 for 6, hopefully going on for 7 for 7. That's a pretty distinct difference. We're running at about a 20% annualized rate of return over this 7-year period, and 20% for the small company component of your speculative and early core part of your portfolio. Can really make quite a difference. Here's a quick look at the companies that we chose last year around Halloween and how they've been doing. Wanted to put it out for a couple reasons. Yeah, emergent, I liked it here too. It's hurting us here too, but the ones at the bottom are so overwhelmed by the ones at the top. Ken, I'll let you go ahead and expound on those two, which I didn't want to include this year. Go ahead.
Well, we had quite a discussion about whether we were going to put banks in this list or not. Traditionally, Forbes had kept asset-based companies out of their study of small companies, and asset-based companies are banks, insurance companies, brokerages, companies that depend on a pile of assets in order to run their business. Banks have to have a pile of money to loan because the whole business is built on loans. But finally, cooler heads prevailed, and we put banks into the list. And I'm really kind of glad we did, because these two banks are really kind of carrying the day. There's a third one down the list here too, at Axos Financial. And there's also a very interesting one that has a positive total return, still has a negative relative return, but Essent Group is also, it's private mortgage insurance. And it's also another one that's moving itself up and contributing green to the total return. So again, we're looking at companies that traditionally in the Forbes methodology we did not look at, and I'm kind of glad we did this year.
Yeah, and I wasn't pushing back very hard. Ken knows that.
Oh, he wasn't. No, he wasn't.
No. Well, I was just disturbed by how many banks were showing up at the top of our screens back at that time, and thank goodness our screens were right. Again, the 20 companies follow along with us. We hope to beat the market again for the 7th consecutive year. The message, the moral of the story, again, is what it all adds up to that matters, not any single company, but this notion that up, straight, and parallel doesn't apply to small companies is baloney, because most of these companies fit fairly well into an up, straight, and parallel mode, and even though they're small. So well-managed companies that are exhibiting excellence, that are on sale, it just makes all the sense in the world, and the returns and the rewards can actually be quite significant. So follow along with us. And here's our summary slide. I'll let you take us home.
Yeah, we'd like to eliminate the words small, medium, and large from our discipline, and we'd like to talk about the best, faster growing companies. We hope that you've learned a little bit, got a few ideas, and we'll stick around a little bit after we close down the recording to answer a few of your questions. So if you want to stick around with us, that'd be great. Mark, thanks so much for all your help and support to make this conference get off the ground. And you and I are going to be back tomorrow for 2 classes. I look forward to those. Any final thoughts, Mark?
Again, just an open invitation to join us for those 2 sessions. And then we also have our May roundtable on May 25th coming up. That's not limited to just small companies, although we do tend to dial up the emphasis on small, as you would expect us to do. We follow our own recommendations and advice, or at least we try to. And again, just a reminder, if you'd like copies of the slides, or if you do have follow-up questions, we will stick around to take some questions here, but send me a note, mark@manifestinvesting.com. Be happy to give you a copy of the presentation. If you are not a subscriber at Manifest Investing, we continue to develop and build out resources for long-term investors. And if you'd like a free test drive, send me a note and ask for it. I'll be glad to give you a test drive, fully functional test drive to check things out. So with that, Ken, I think we can say thanks, everybody. And
thanks, everybody. Good afternoon. And we hope to see you at one of the upcoming classes in the Successful Investing 3 conference. Good afternoon, everybody.
Thanks, Ken.